Dr. Armstrong, University of Minnesota, thank you so much for having us. On behalf of myself and CIH, we appreciate the opportunity to get together with the fine cattle folks of Minnesota. Before we start, just a little bit about CIH, for those who are not familiar. Commodity Ingredient Hedging. It's a financial risk management firm for agriculture producers and buyers, established in 1999. We generally take a three-pronged approach to risk management. We offer consulting and education services, and we utilize an in-house software to model out risk management strategies. And then we offer insurance and brokerage in-house to execute those risk management strategies. We have over 600 clients in 15 different countries, working in the hog industry, dairy industry, beef, ethanol, poultry. We work with food and snack companies, grain originators, feed mills, and some dairy and pork buyers. I work on the beef team. I've been with CIH on the beef team for about 10 years now, working with cow calf producers, stockers, backgrounders, to feedlots, large and small, feedlots that own 100% of the inventory, or custom feeders throughout North America. So we pretty much cover the entire cattle feeding industry, or cattle industry. Today, we'll kind of do a bit of a broad overview of the cattle market. I'll let you know right now, like, I don't have a silver bullet for you, or the 2024 high and low. But generally try and cover what's happened in the market, and then we'll discuss livestock risk protection, LRP, and hopefully a better understanding of the volatility of the market, what's driving the price action, and how LRP might be of use to you. This slide comes from the USDA biannual cattle inventory report. So our last report was in July of this year. In that report, total cattle inventory was down 2.7 million head, year over year, down almost 5 million head from 2021. The beef cow inventory alone down 750,000 head year over year, and down almost 2 million head from 2021. General idea, which you're all aware of, cattle industry is going into declining supplies. We get an update on this report in 2 weeks on January 31st. What we've generally seen in 2023, heifers as a percent of feeder receipts has been historically high through most of the last year. So according to USDA data, we heifer retention on a wide scale that would suggest a big increase, or big rebuilding of the herd. Also, the cow slaughter, throughout 2022, it was at a 10-year high, and then it remained historically high through 2023. So the gist of this is declining supplies, and then as we kind of look ahead in the report in the next 2 weeks, we expect the same type of storyline. This report in 2 weeks is likely to show record small feeder inventory into 2024. Again, supporting that declining supply story that we've realized the last year. With the tightening supply outlook, you would expect cattle on feed reports to reflect that. As we walk through some of these reports over the last 6 months, in the August report, this would reflect July placements. They were down 8% year over year. Marketing's down, and our on-feed numbers down 2%. This supports that declining supply expectation. As we moved into September, it again showed August placements down 5%, on feed down 2%. As we moved into October, there was a bit of a surprise with placements up 6%. And then, to add to that, marketings were down 11%. So as we think back, we've got this declining supply expectation, a bit of a bullish expectation and outlook in the market. And then after this October report, we get a surprisingly large placement. And with on feed down 2%, we killed 11% less. That was a bit of a disappointing report, which was followed by the November similar story. Placements up 4%, slaughter down 3%. And to close out the year, placements down 2%, but marketing's down 7%. And so if you think about these reports, and you think about them in terms of forecasting price, which, generally in the cattle business, we're looking to the CME and we're looking at live cattle futures and feeder cattle futures, is kind of your benchmark to forecast price. These reports, they present some uncertainty, in the ability to forecast price. So you're expecting declining supplies, and then we get a large placement. We're also going into declining supplies, but the kill slowed down, and so marketing slowed down. So as we got into the end of the year, our on-feed number actually grew, which again is a bit at odds with the cattle inventory report, that we had gotten back in July, which leads to uncertainty in price forecast, uncertainty in the futures outlook. You can see that if we kind of look back at the cash market and the futures market. So in this chart here, the blue graph is the February 2024 futures. That black line is the 5-area cash. In the little dialog box, you'll see the first, and that Monday of September 25th, cash market was at like 185. On the left half of your graph, you can see that black line, that cash line, it was relatively stable. Cash had stayed in the 180s for several months. Cash was stable, cash was historically strong. We, at this time, still generally had bullish fundamentals. We still had an expectation of, declining placements, declining supplies, and that was reflected in the futures market. Cash was at 185 in September, and then projecting cash to the following February, kind of to where we're at today, the futures market was at 195. We still had a bullish outlook, a bullish expectation of price. As we kind of fast forward through time, and we kind of got these bearish fundamentals, these bearish placements, this declining pace of slaughter, that outlook changes and that expectation of price changes. So from September to December, the futures market dropped $30. Over that same time frame, the cash market went from 185 to 170. So, the changing fundamentals impact the expectation of price, but I think the uncertainty of those fundamentals impact the volatility. And so the futures were much more volatile than the cash. The cash only broke $15. The futures broke $30. But in hindsight, the futures were $10 higher than cash was. So the futures were maybe a little bit overly optimistic, and maybe in hindsight, the futures were a little bit too pessimistic on that move. So it's not to say like one is right or one is wrong, or to kind of say the futures are wrong, but the point is, there's uncertainty in the market which leads to volatility, and the volatility has been greater in the futures market than cash. I think part of the explanation of that, is managed money and the impact that they have on our market. So this looks at the managed money position going back 10 years. So this middle line here, this dotted black line, is your average over a 10-year period. And then you've got your min and your max and kind of everything in between. That red line is 2023. So into the summer and into those bullish expectations due to supply and declining supply, managed money had their largest net long position over a 10-year period. That means they were long the market. They had bought futures, and maybe part of the reason why those futures had exceeded the cash market. In hindsight, that can be a good thing because it presents an opportunity to manage risk at a price that exceeds the cash. The problem, is that if they get out, that leads to a lot of selling pressure on the market. And so what's happened in the last 6 months is managed money has gone from their largest net long position to their current position today, this little blue dot here on the bottom left, net long 13,000. And the last 10 years, that position has only been smaller in 2016. Today, again, if you look at their position in July, they were net long 120,000 contracts. Today, they're net long 14,000 contracts. That's a huge swing. Again, probably why the futures broke $30 when cash only broke $15. I ask clients not to think about this in terms of what are funds doing or why they're doing it, but think about this position in extremes and think about this position as it relates to the supply fundamentals, the supply demand fundamentals of the cattle market. So think about where funds were, think about where funds are today, their smallest position, in 10 years. And then again, think about the fundamentals and the expectation of the market going forward. Last Friday, we got a WASDE report. In the WASDE report, USDA gives us quarterly beef forecasts. So if we look at this report, in 2022, we did about 28 billion pounds of beef on an annual basis. In 2023, we're projected to do about 27 billion pounds of beef production. And then our latest update, we're forecasting about 26 billion pounds of beef production. The USDA will make tweaks and revisions to this every month. For what it's worth, in the latest report, they actually revised beef production higher this year, and they revised their expectations for 24 higher, based on a larger slaughter and higher dressed weights for the first half of this year. We are still forecast to go into declining supplies. So this is projecting another 3 to 4% drop in supplies. The increase that we saw in the last month, partially due to weights, which may be impacted by the weather that we've seen across all of cattle country. And the other thing I would note with this report is Q1 is projected to be our largest beef production for the year. So from Q1 to 2 to 3 to 4, the USDA is forecasting lower beef production each quarter. So as you think about that, and you think about the managed money position and the impact, that funds can have on the futures market, I think it presents a lot of, again, uncertainty, and it presents a lot of, potential in this market. We have, hold on, we have two more supply reports out for the month of January. On Friday, we have a cattle on feed report. And then again, we have the next cattle inventory report. You know, both of those reports, I think, can have an impact on the futures market, futures volatility, and the feeder cattle market. If we look back at the feeder cattle market over the last 2 years, there's been a $100 range in the feeder cattle index. Feeders are $28 off the high, and the 5-year average on the feeder index is 162. So, think about those and kind of lock those in your brain. Think about those swings. $100 range over a 2-year period, $28 off the high. Feeders today are $40 above the 5-year average. This chart alone and the price action today relative to our average prices both represent a tremendous amount of potential and opportunity. This is the feeder cattle cash index, but we've also seen the same kind of volatility in the feeder cattle futures, which I think some of that can also be explained by the impact that managed money has on the cattle market. So this chart looks at the managed money position in feeder cattle alone. If you go back to September of 22, funds were short about 10,000 contracts, net short. If you go to the peak of our futures rally and feeders into this summer, managed money was net long, just shy of 20,000 contracts. And then if you look at their position today, they're net short about 2,500 contracts. So with a WASDE report with the potential for a cattle on feed report to show declining placements and the potential for a cattle inventory report to show historically tight feeder cattle supply as you head into that period, managed money has a net short position on the market. As you compare that historically, their position has historically been much shorter than where we're at currently today. Again, I think those things both represent potential opportunity and risk. Without going too much into corn, when you're talking about feeders, and the potential on feeder cattle, it's important to note corn. Again, I don't want to forecast corn prices or get too much into corn in the specifics, but corn as it relates to feeder cattle, if you're feeding cattle right now, today, corn on the board, it's the cheapest price relative to any animal that you've had on feed. Any animal that's alive that's been on feed. Looking back, historically, corn has gone, from coming out of COVID, $3 to up to $8, and it's backed off to $4.40. That's quite a bit of volatility that we've seen in the corn market. The volatility in the past, probably 3 or 4 years, greatly exceeds what we experienced through 2014 to 21 market. And this volatility in corn, has a pretty substantial impact on definitely feeder cattle, but also the live cattle market. So, these price forecasts, and as things change over time, it impacts the uncertainty, the expectation of price. Managed money has an outside influence in our market at times, which impacts a lot of our volatility in markets. And in general, in the cattle market, we're going into this continued expectation of tightening supply. And in tight supply markets, you typically expect greater volatility, which we've seen over the past year. I think the other side of the equation, is the demand side of things. So we're expecting this tighter supply in cattle. How does that impact demand? What does demand look like? and how does demand impact our price and our price expectation in the futures? If you look at choice beef, this is last week before the winter storm. Choice beef was 285. That was the highest choice beef in January on record. We kind of had our holiday, our post-holiday lows. We've seen a little bit of a bounce in choice beef. Year to date, choice beef has traded from 275 to 295. I think the recent run up that we've seen in choice beef has been, an impact of the drop in production that we experienced last week with weather. I think we have seasonals to deal with choice beef. Choice beef typically kind of bottoms into early February, rallies into the spring. You get these beef demand holidays that impact choice beef. You get these rallies, breaks throughout the year. In the past year, with declining production, we've seen exports declining. We've seen imports increasing, trying to make up for that shortfall in production. I would argue right now, beef demand is really good. Again, if you think of the choice beef price year to date, it's been 275 to 295. Q1, based off the USDA WASDE report, Q1 is our largest beef production for the year. And January is typically our worst demand time for beef. So through all of that, the box beef price is still at a historically high level, and we're expecting declining supplies throughout the rest of the year. So I think that's generally a good thing. And I think if you look at the right half of this chart, that red line is choice beef through 2023. We spent a lot of time with choice beef over $3. Part of the job of the market is to kind of ration supply or ration, the declining supplies. We see that a little bit with the box beef retail prices. Okay, retail prices right now are at an all-time record high for December. They've backed off a little bit over the last 2 months. If you look at that green in the middle of that spike, that's COVID. So we had a major production setback during COVID. Box beef prices shot higher to an all-time new high. They kind of backed off, and I think the inflation discussion has really taken hold, and maybe that's part of this, but box beef retail prices have steadily climbed higher since that period. Again, box beef prices you should expect them to continue, or excuse me, retail prices, we should expect them to remain elevated, to kind of ration the drop in supply that we forecast at least for another year. I'm not so much concerned about our box beef price is too high. What can we put on the consumer? I think those are good questions. But I think when you look at box beef prices relative to where they were last year, and you look at retail prices today, versus where they were historically, they bring up more the margin discussion in the cattle industry. So where does all the margin come from? Who can we get margin from, right? Can we squeeze more margin out of the retailer? Will the retailer give up margin to get consumers in the door? Does this get pushed on the consumer? How much can we push on the consumer? Does the retailer push this onto the consumer? It's kind of testing the limits, and I think that's a little bit what we did last year. But this capturing the margin leads to a lot of, or a challenge to forecast price, and a challenge to say how high can this thing go, or where does support come in this market while we continue to have tight supplies. If you think about margin, not just from the retailer, but there's margin between the packer and the feedlot. And there's a leverage component between the packer and the feedlot. Again, I think that leads to price uncertainty, which lends itself to volatility in the futures. The leverage, and the capture rate between the packer And the feedlot alone, can lead to, some, I guess I'll say, crazy what if scenarios. This chart here it's kind of like a packer margin proxy. So this chart it's the cash market as a percent of choice beef. So how much of, that choice beef is the feedlot able to capture right now? On the blue over here on the left, in your first, white box here, this is our current 61% capture rate. So today, feedlots are getting the highest percent of choice beef in the last 10 years. If you kind of shift your attention towards the right side of this chart, that red line is 2023. And for most of our summer and fall, it was the same deal. Feedlots were getting, their highest capture rate in the past 10 years. For what it's worth, that big spike down at the bottom, that's 2020. That's COVID. We had zero leverage on packers. But the point here too is kind of that margin discussion. Who gets the margin? Who can maintain the margin? When the packer really lost margin, they slowed kills down. The boxes didn't really rally towards the second half of last year, and we've kind of gotten backed up, and we lost that margin through the end of the year. If you play around with these different what if scenarios, and you kind of move from box, one to middle to the right, again, it shows you how much price swings you can create in different what if scenarios. Our 10-year average for this time of year is about a 55% capture rate. At a 290 choice and an average capture rate, that's a 160 cash market. Last week we were 171, 172. That's a pretty dramatic swing. That's a $10 break in cash, even with boxes moving higher. If you think about it from a broader perspective and you think about the choice market last year, we traded choice as high as 340. We spent a lot of time with choice at $3. And we spent a lot of time last year capturing 60% of that choice. A 325 choice at a 60% capture rate, projects a 195 cash market. That's, another $20 higher than where we're at today. So the point here again is more about, the declining supply and impact on volatility and the volatility that we see in our markets. There's a lot of things that are impacting our markets. It's margin, it's leverage, it's managed money, it's supply forecasts, it's imports, exports, etc. But these markets I think are much more. Even when I started in cattle and in the last 10 years, markets are becoming more and more volatile, and these swings are more and more dramatic to your bottom line. The live cattle cash market last year had a $33 range. If you look at where futures started in 2023 and our highest print on the April futures market at 198, it's a $44 range in futures. Feeder cattle futures 178 to our highest print around 282. It's a $104 range. And the same idea with choice. It's an $80 range in the last year. Tight supply equals volatility. There's an inverse correlation to supply and volatility. Markets will become more volatile as supply is tighter. And so I think the goal and the objective is, how can I participate in as much of these moves higher and that push to cash to 188 and that push to futures to 198 without taking on too much risk? How can I participate in a rally, and eliminate as much of the downside as I can? And I think that's where, livestock risk protection, really can be a very valuable tool to, a feeder, a feedlot operation, anyone with feeder cattle risk. So we'll walk through kind of the basics of LRP. hopefully you have a better understanding of it. There's a few confusing tidbits on feeders, and then we should have time for some Q&A. In very basic sense, LRP is price protection. It's insurance against a declining market. LRP settles to live cattle cash or the feeder cattle index. I think that's an important component to understand. And we'll go into that a little bit later. The way LRP is priced, it comes out every single day. Prices are usually released at about 3:45 Central. You can buy coverage as early as 13 weeks and as far out as 52 weeks. The coverage prices are updated daily based on live cattle, feeder cattle, futures, and options. LRP is subsidized. The subsidies range from 35 to 55% based on the coverage level that you buy. And the premiums are due at the end of coverage. So that's been a big change to LRP in the last few years. The LRP premiums line up with the revenue on your cattle. So you can buy protection for cattle that'll kill in whatever it is, 20 weeks, and you don't owe anything until those cattle are killed. So in general, you can buy protection, get your payment from the packer, and then you'll owe a premium if the price exceeds your coverage. LRP is also customizable. So, you choose the coverage price, you choose the length of coverage. You can endorse a specific number of head. You choose the weight to endorse. So it differs from, the board in the sense that, a futures contract might cover, 28, 32 head. With LRP, you could cover 40 head to 1,350 pounds. And you can cover LRP on July 15th versus using the August board. In a lot of ways, LRP, it's price protection, it's price insurance. So it's similar to like using options, using futures. So we look at that in a lot of ways and compare it to what can you get done, with the exchange. LRP is subsidized, deferred cash flow. Again, that specific coverage period, you can cover, June feeder cattle. It has sometimes a pretty dramatic impact on your basis because you can cover the cattle in January instead of using the February futures. There's no minimum and there's no margin calls. Some of the drawbacks with LRP, it's less flexible, meaning once you buy a policy, you are committed to that policy. You cannot get out of it. And for some, the head limits can be a drawback. You can cover 25,000 head a year. If you kind of walk through, the nuts and bolts of how it works, again, prices are released on a daily basis by the RMA. They provide the coverage price, the end date, the endorsement length, and the premium, the cost for that insurance. Typically, we'll get those prices at about 3:30, 3:45 Central. You have until 8:25 a.m. the next day to sign and submit your endorsement. This is also important. LRP is released on Fridays, and you have until Saturday morning at 8:25 to put on coverage. If you think back to October, we had that surprising cattle on feed report. where placements were up 6%, and on feed, surprised up 2-3%. You actually had an opportunity to put on LRP following that report before the market had opened on Monday to trade that report. So there is some benefit to when LRP is released and the time frame you have to get it in the next morning. Until then, you get your signed endorsement, you have coverage, you're locked in, and there's really not much you do until the coverage ends. If the coverage price exceeds your ending value, an indemnity is paid. The ending values are based on live cattle cash or the feeder cattle index. Again, there's an important basis component to LRP. If cash is at a big discount to futures, your LRP settles into that discounted cash. You don't get stuck with a negative basis in LRP. If your LRP endorsement does not pay, and you owe the premiums, you have 1 month until the end date to send that bill out. So that's where that deferred cash payment also helps as well, because typically you'll have been paid by the packer or whatever the buyer, you get your check and then you owe your payment. The coverage price, oops, sorry here. Coverage price determined by the RMA, and then that subsidy gets applied. The end dates are every 30 days. Again, so you can align your coverage better with the marketing date of your cattle. Couple, different caveats between live cattle and feeder cattle. There is only one available group for live cattle. So whether you have steers or heifers, you cover live cattle and you determine the weight, 1,000 pounds to 1,600 pounds. It's one price offering. It's one endorsement, whether you have steers or heifers. You just pick it's pretty straightforward. It's almost very easily compared to a put. Feeder cattle become a little bit more confusing. There's 11 available groups to cover feeder cattle. So when determining a feeder cattle policy, you have to elect if they're steers or heifers, if they're predominantly dairy, Brahman. There's also another category for unborn cattle. And then within steers, heifer, dairy, Brahman, you have a 600 to 1,000 pound category, or under 600 pounds. We'll start with kind of the easier view. If you look at a live cattle quote, this is from last week. So I'm going to draw a little bit on here, but this highlighted group here, the RMA will say the end date is April 12th. You get 13 weeks of coverage. This is the expected ending value of the market that week, that day. RMA is offering 99% of that expected ending value, which puts your coverage price at 172.80. The cost for that policy is $547. You will get a 35% subsidy on that, and your net premium is $355. Again, I think the reason this is a little bit more straightforward on live cattle is because, it's your coverage price minus your net premium, and you can determine what your floor is. You could determine what your worst case scenario is. In this view, there's coverage May 10th, June 7th, July 12th, and so on. So, sometimes if you have like October cattle, but they might be, September cattle. Well, you could cover cattle on September 6th instead of using the futures board, which is going to forecast price at the end of October. It's not that it's always a no-brainer, but it's a really good tool and I think good comparison to say, well, what are my options if I'm managing risk and how does this one compare to the other one? This becomes pretty straightforward with live cattle. Feeder cattle are a little bit more confusing, and that's because the coverage price, it's based on the expected ending value and the PAF, the price adjustment factor. Both reported by RMA, they are based off current board prices. The price adjustment factor will adjust coverage and settlement prices based on the type of feeder cattle that you've chosen. So in this example, again, in this example, we're looking at steers. Take note of the steers here, a 6 to 10 weight. So essentially an 800-pound steer is going to be priced at 100% the value of the coverage, and it's going to settle at 100% the value of coverage. So in this example, the index is at 180. The steer coverage is 180. Because when you go to the auction, the 800-pound steer doesn't trade the same price as the 800-pound heifer. There is a price adjustment factor in your coverage. So the heifer is going to be 90% of the steer. The steer covered at 180 is going to be a heifer covered at 162. What's important to note is the coverage starts with these price adjustment factors, but it also settles to these price adjustment factors as well. So if you were to take, the index today I'm going to draw here at 225, and you say, well, I have heifers. What do my heifers settle into if the index is at 225? It's going to take 225 at 90% and settle all the heifers at 202.50. What I tell clients is if you're looking at feeder cattle coverage, go to the steer coverage and use that as your benchmark. If that's a good price, then whether or not you're covering heifers or lightweight cattle or unborn cattle, these are all just a price adjustment factor off of the 800-pound steer. If the 800-pound steer price is high, everything else will be high. The RMA is just trying to account for the fact that, in the real life, everything trades at a different value. And so they kind of adjust with this price adjustment factor the coverage level on different groups of cattle and feeders. I'll show you another real life example of this. Again, this is from January 12th. So you've got an end date of April 12th. The steer 600 to 1,000-pound category. The coverage price being offered is 230.86. The net premium is 568. This works like a put in the sense that you take your 230.86 minus your net premium, to get your floor. It's a 225.18 floor. In my opinion, if that price looks attractive, but you have heifers, then this heifer price is just as attractive. Because the coverage price for heifers down here at 207.77, it's just 230.86 times 90%. Apply that price adjustment factor and you get to 207. The net premium is actually also 568 times 90%. It gets you to 511. Your floor here is 207.77 minus 511 is 202.66. These are different values, but they're the same coverage because both of them will settle into the feeder cattle index on April 12th. The feeder cattle index today is about 225. If it stays right there when we fast forward time, your coverage, your floor is at 225.18 on the steers. You'll get a small payment on your inventory. 225 is below your coverage price of 220 or below your floor of 225.18. 225 index is above 202.66. But to get the settlement on this heifer, it's 225 at 90%, which is 202.50. Both of these policies pay out. If the steer 800-pound price is attractive, the heifer price is really the same coverage. It's just being applied a price adjustment factor. I think in my experience, this price adjustment factor has been the most confusing for folks to understand. Again, my recommendation would be if you're ever quoting them, go to the steer 800-pound price and work backwards from there. The other thing I think that, should be addressed a little bit, is the fact that LRP is not flexible. And that's true. Once you buy a policy, you cannot get out of it. You're kind of committed to it. But you can use additional hedging strategies alongside of LRP. What I've done here is basically take an LRP policy on August 9th. The coverage is 251, and that'll cost you 958. I'm not really recommending this, so don't walk away with this, but what I'm showing you is that this top line is, okay, you could buy the LRP for $9. I think your second option could be you can buy the LRP and sell a call. In this case, you could sell a 280 call for $5. You bring your cost down from 945 to 445, your net cost. You more than cut that in half. And the reason I bring up this third option is to sell a call and sell a put is the combined premium from the call and the put equals 925, which offsets almost all of your LRP premium. So by using options, you can offset half to all of your LRP premium. By doing that, you introduce a very different risk profile, and your adjusted risk is very different based off of what the market does. So the reason I say I'm not recommending this is because, I don't think this is something people should do across the board. I think anybody that's involved in the cattle industry can think back over the last 3 months and realize why, strategy like this would be just an absolute disaster. My main takeaway with kind of this slide is to say, yes, LRP is not flexible, but the more I think you educate yourself and the more sophisticated and knowledgeable you become with futures and options, you can combine a lot of these strategies together, and create different risk reward profiles and different strengths of hedges. So there's not flexibility on LRP alone, but you can create flexibility with options. which, can create risks. So I would just say do that cautiously and make sure you do it with somebody you trust, and make sure you know what you're getting into if you were to do something like this. This chart becomes a little bit noisy with the colors, but I'll just go through real quick. This blue line here, this is just buying LRP for $9. You've got a floor, over here on the left, your P&L will never drop below that floor. On the way up, if we go all the way up to $3, you're $9 behind the market. If we rally $50, if we have a market like we did last year, well, that's a great year. The next option is, you buy the LRP, you sell a call. That's this orange graph. Your floor is a little bit higher because your cost is lower. So there's your benefit. You pay less for insurance. The drawback is, your upside is limited. Maybe that's not a drawback for everybody. The third option is you buy LRP, you sell a call, and you sell a put. The problem with that sold put is you run out of coverage. So you have very cheap coverage on, but you get what you pay for. And you can see here in the gray, you become back open, exposed to lower prices. So I think, the more knowledgeable you can become with LRP, and you can add it into, maybe a risk management strategy that you're using, you can include some flexibility with it. That concludes my recap.
Perfect.
I hope I haven't thrown too much at you all. My contact information on the screen if you want to email or follow up with any questions, or if you want to kind of open things up for questions.
The first question we have is from Kevin. He says, I have 30 to 40 calves that go to the feedlot and I hang them and then get paid by carcass. Does it pay to lock them in with that few?
I would say yes. I mean, the market just broke $30. So, what I would recommend is you kind of, try and track your your projected margin on the cattle. And, if you can get to a point where that projected margin, even minus $5 LRP, and you can put yourself into a position where the cattle make money, even if you lose that $5, then yes, looking back over the last 6 months and the equity swings in cattle inventory in the last year, I would say it definitely agreed. It pays to do it on that small head. And also, the last thing I'll say, LRP was designed for the 30 to 40 head guy, not for, the big corporate feeders.
The second question is, the premium, is it per head for the live cattle, or how is the premium? Is it per hundredweight or per head?
It's per hundredweight. So to determine your premium, you'll determine how many head you're covering, how many total pounds you're covering, and then that multiplied by that. On my live cattle quote, I think I said 355. So it would be, 100 head times 1,350 pounds times 3.55. So it is per hundredweight, which allows for an easy comparison to like maybe what a put would cost.
Okay, our next question is, what happens if you estimate the wrong date for finished cattle? Grow slower because of weather or faster?
That's where the flexibility, the lack of flexibility becomes a problem. You can sell your cattle within 60 days prior to the end date, and there's no penalty, and your policy is still valid. So if you have, right now, let's say you've got a February 25th end date and you sell the cattle today, you're within that 60-day window, and you could actually still have coverage. And that coverage is not dependent on where you sell the cattle. It is determined by the 5 area cache that week. If you go beyond your end date, there's no penalty, but you would still owe the premium. So again, that lack of flexibility can kind of become a problem, because if you say, well, they're covered to January, but they won't kill in February now, you would risk running out of coverage and still owing the premium.
All right, thank you. The other question that I have so far here, Charlie, is what happens if you have the LRP on feeders and you decide to retain ownership rather than sell? And I think that kind of answers in the same question that we just had.
Well, so you can retain ownership. So if you have them on feeders and you retain ownership, you just have to you have to show proof of ownership to receive an indemnity on any LRP that you write. And if you retain the ownership, you have to sign a letter that attests the retained ownership. So with our clients, we kind of, you sign a letter and you send it to the insurer and say, I owned the cattle, here's my proof of ownership, and I have retained ownership, and you can actually still collect your indemnity.
Also, I had one, and this might be a little off topic, but I had one come in through email yesterday, and the question was about making a decision to retain ownership and feed themselves, or custom feed, or just sell the calves outright. I don't know if you feel comfortable talking about that decision and how that plays into, if you have an expiring LRP at the same time, how you make that decision. There's a lot of factors into that, but do you feel comfortable commenting on that, Charlie?
I mean, not without giving a good answer, because my initial thought, Joe, is what you said. You'd almost want to talk to the person on it'd be like a specific basis. Like, why are you going to retain ownership? What's the benefit to retaining ownership? You probably do a little bit of math, I think there's just a lot that goes into that.
Yeah, and I think it kind of ties into some of the other questions that are coming in now. Basically, the questions are from our farmer feeders that are retaining, you raise your own calves, and then you're also finishing them. What's the best way to use LRP in that kind of farmer feeder scenario?
I mean, I think personally, I think the best way to do it is to use LRP. I mean, this can change, but I mean, I like using LRP as feeder cattle, because you do actually retain a lot of flexibility. If if the market really screams higher, like you just have this defined cost on the feeder cattle LRP. So you can sell them, and if you decide to retain ownership, that's okay. The market has exceeded your LRP cost. You've had, a few months to digest it, and then you just kind of got to go and hedge them again as live cattle. But it provides a lot of flexibility and a lot of time to make that decision. And in the meantime, it unloads all the risk on you if the market takes right in front of you, because you have that protection, but you can still feed them, because the market can crash and you can say, well, why don't I just retain ownership, and why don't I just collect my insurance on them? And you can still do both. So you can cover them to 800 pounds, and you don't have to make a decision on what to do. You can cover them to 1,000 pounds, and you don't have to decide what to do until then. And you just kind of let the market dictate it. So I think using the feeder cattle LRP provides a lot of time and flexibility to make your decision, even though you don't have flexibility with the insurance.
That makes sense, and I like that answer. I think there's a lot of the flexibility is important with the volatility and being able to. I mean, I think there's a lot of procrastinators here with that decision, and that's a good thing. It gives you that flexibility. One of the other questions that's popped up is, what is my premium for unborn cattle?
Unborn cattle are going to be 105%. The price adjustment factor is going to be 105% of a steer. So you would go to the 800-pound steer, it would be that price times 105%.
Perfect. So one question that I've had before, Charlie, and want to get your take on it, is how do these beef on dairy animals fit into LRP?
They're generally considered beef cattle, steers and heifers. I mean, they're fed into beef production. They're primarily beef cattle, and so they're covered as beef.
There was one more question here. Can you select a lower coverage amount with a lower premium just to protect against a total black swan event?
Yes, you can. Yes. So the subsidy will be 35% at your highest coverage. The subsidy goes up to 55% at lower coverage levels. So it's kind of like the government's way of subsidizing you more just to even put on disaster coverage. But yeah, that's the screenshots I showed you was just the highest coverage. You do have, depending on what RMA lists that day, you do have a few different options. Sometimes you'll have like 8 different prices that you can protect. So you could spend just a couple bucks on disaster insurance. University of Minnesota Beef Team, Dr. Armstrong, thank you so much for having me.
Yeah, I really
Thanks,
appreciate you being
Charlie.
here, Charlie. Really appreciate it. Thank you, everybody, for coming. We will hopefully see you again in 2 weeks with Clint Fisher to talk about business entities and get ready for a great Valentine's Day date. And hopefully I'll be entertaining enough for that on the 14th. All right, have a good night, everybody.